So hello and welcome to the webinar on pensions and taxation for Australian expats. Thanks for joining. Feel free to put the questions in the Q&A box and we'll aim to get through as many as we can today. And this will be recorded, so I'll make sure everyone receives a copy as well. My name is Carl Turner. I'm the co-founder of Expat Tax Thailand, and the purpose of this presentation is really to provide the up-to-date information for Aussie expats living here in Thailand. Here at Expat Tax Thailand, we're here to help individuals really understand their Thai tax filing obligations so they can make better informed decisions. Now, Expat Tax Thailand, we are a Thai-registered, Thai majority-owned company, specializing in helping expats file their Thai personal income taxes and provide ongoing advice and support. All the accountants, they're authorized and regulated through the Federation of Accounting Professionals. And my role is purely to explain to expats the roles in simple terms and act as the go-between between the accountants and the clients. So let's go through this in a bit more detail. So, okay, there we go, it's working now. So this webinar, we are recording it, and the main purpose is for anyone who has Australian pensions or assets that are living in Thailand, or for Australians that are looking to move to Thailand and haven't quite yet moved, who are considering relocating. So what are we going to discuss today? We'll go through the Thai income tax rules, explain what are the key dates, what is taxable, what isn't taxable, go through the tax allowances and deductions, and explain about double taxation agreements, go through some case studies, and then we'll get in the Q&A. So if you do want to put the questions in there, we'll get through them at the end. So we've got many videos and content and resources available on different topics, whether that's investment capital gains, property, income, and how that's taxed as well. So if you want to have a look on there, there's plenty of content that might be useful for you as well. A quick disclaimer before we start: the information is for information purposes only. It doesn't constitute professional advice, shouldn't be acted upon in isolation. It's just to explain the rules and isn't specific advice. So let's go into the detail. What tax changes have been announced? So the Revenue Department of Thailand, they actually issued a revenue order to overrule previous tax rulings. It was published in the Royal Gazette on the 6th of October last year, 2023. It was regarding offshore income remitted to Thailand as a Thai tax resident. It came into force the start of this year, 1st of January, and it's got a significant change for expats that are living in Thailand over 180 days or more, for people that bring in things like investment capital gains, pensions, rental income. Thailand is a remittance tax basis, so it means if money is transferred to Thailand and you are there for 180 days or more, and it's potentially taxable if you do that now. So what are the key dates? Yeah, I mentioned earlier, 1st of January is the start of the tax year. 31st of December is the end of the tax year. So it's a calendar year, unlike Australia. So it's the complete opposite. And the last date to file a paper-based tax return, if you need to, is the 31st of March and 8th of April if you file online. So the Revenue Department, they've actually issued quite a lot of information regarding these changes. They produced quite a nice official document in July this year explaining how do foreigners living in Thailand pay tax and how do they file. So like I mentioned, it affects most people that are living in Thailand 180 days or more in a calendar year. Doesn't really matter on your visa status, whether you are retirement visa, marriage visa, business education, smart tourist, doesn't really make a difference. Apart from the LTR visa, long-term residency visa, that has some tax advantages. So maybe for certain people on this call, that might be suitable to because it's exempt from foreign source income being brought in. So that might be suitable for certain people. I've got a webinar explaining that in more detail if you have a look on our YouTube channel. So let's talk through what is taxable in Thailand and what the revenue code actually shows. So this is section 40 of the Thai revenue code. You can see on there under part 2, salary and pensions are on there. And part 4, investment capital gains and dividends, rental property income, property sale. So if these are all types of income source in Thailand. So if these types are remitted, transferred into Thailand, then they are potentially assessable income, so taxable in Thailand. So we know that pensions, salary, investment capital gains, dividends, rental property income, property sale, crypto sales are all assessable income if they're brought to Thailand for a Thai tax resident. What isn't taxable? So if you leave overseas assets overseas and don't remit. So remember, Thailand is a remittance tax basis. So you're not taxed on your worldwide income. You're only taxed if you, at the moment, only as long as you remit, transfer the assets, spend the assets in Thailand and you live 180 days or more. Also, what isn't taxable? Cash in the bank as of the end of 2023. So the cash balance as of the 31st of December 2023 can be remitted into Thailand anytime in the future. That's not assessable income. If you have investments and you don't make money, or a property and you lose money, you can bring in, if you sell and bring in, then that's original capital because you've got losses on there. It's not the only tax on the gains. Inheritance, if you get an overseas inheritance, that's not assessable income in Thailand. Important, if you have an Australian civil service pension, including military pension, that's not assessable income. You can bring that into Thailand. You don't have to file for those specific assets. Gifts and loans, certain types of loans and gifts are not assessable income, but it's quite complex. There's a whole webinar on this subject. And if you are not a Thai tax resident and you transfer money, so let's say you're not in Thailand 180 days and you transfer money in, then that's not assessable income. So I hope that's useful. So what if you don't have assessable income and no income? Do you have to file a tax return? Well, the answer is no, unless you meet the criteria for filing. Let's say you've got cash in the bank and you live off that, or you've got civil service pension. You don't need a Thai tax ID number and you don't need to file a Thai tax return. You just need to keep a very good record. So does everyone have to file a tax return? No, not everyone. Only if you've got assessable income in Thailand. So either domestic income, so if you've got a Thai rental property income or you've got a salary in Thailand, yes, you have to file a tax return. Or if you stay in Thailand 180 days or more in a calendar year and you remit, which just means transfer, foreign sourced income. So what I mentioned earlier, things like pension, rental property income, investment capital gains, dividends, things like this. If you don't meet the criteria, you don't need to file. If you do meet the criteria, then you would need to file a tax return. So what are the minimum requirements to file? So there are thresholds. So let's talk about who needs to file. So if you stay in Thailand 180 days or more and you bring in foreign sourced income, so you bring in a pension or rental property income. Well, if you bring in a pension and you live more than 180 days or more, if you bring in over 220,000 Thai baht from a super and you're married, then you need to file a Thai tax return. If you're not married, then the limits are lower. You only have to bring in 120,000 Thai baht per year in order to have to file. If you bring in rental property income, then the limits are lower to have to file. So it's 120,000 of rental income a year if you're married, or 60,000 if you're not married. And if it's investment capital gains, it's the same rules. 120,000 Thai baht of investment gains if you're married, or 60,000 if you're single. So you can see the requirements for filing are quite low, but just because you have to file, it doesn't mean you have a tax issue. It just means you get allowances and deductions in Thailand. So I'll go through all this. So let's say you do have to file. What do you need to do? So you'll need to obtain a Thai tax ID number. You're not automatically given this. You have to apply for one. It's a 13-digit number. Even if you have a pink card, like you've got a pink card in Thailand, you still need to register that to be able to use as your tax ID number. So if you need a tax ID number, you can either visit your local revenue office and apply directly with them. You have to take your supporting documents and drop off the documents and then pick that up a few days later. It's important to take someone, if you can't speak good Thai, to take someone who can to help with the process. Or if you'd like a simple solution, we do have a tax ID number service. We can obtain that on people's behalves. Once you have a Thai tax ID number, then you'll need to file a Thai tax return. So that will be if you've got things like pensions or rental property income or investment capital gains, you need to file a PND 90, which is at the end of the tax year. So you can file for the current year. You can file from the 1st of January all the way up until the 8th of April for the current tax year. Now you can file, there's a few different ways you can file. One, you can go to your local revenue office and do this paper-based, fill out the forms, go through that with them direct. Two, you can file online with the revenue department. Or number three, we have a paid service, for example, to help people file remotely online through our client portal and remain compliant. And we guarantee the allowances and deductions. So yeah, we do have a TIN service if people would like us to obtain that on their behalf. And the tax filing service is our core business. So for Aussies, we have a service available. Most fit in within the essential, the cheapest option, because you don't have tax credits to offset. So the filing price is quite cheap for most Australian nationals. Let's talk about the double taxation agreement. So I have many questions from Australian nationals and people who've got Australian pensions to say, what does this double taxation agreement show? Do I have to pay tax on assets? How does it actually work? So all the double taxation agreement shows is it takes precedence over a local domestic tax rule. So if something is said in the DTA, then it overrules the local rules. So there are 61 double taxation agreements, and it's all to do with where your assets are based, not your nationality, actually. We've got a dedicated webinar, an hour long, just specifically about Australian double taxation. If you'd like to view that, that's on our YouTube channel. And we've got many other videos for other countries. So if you've got assets in UK, US, Switzerland, for example, then we've got videos on this as well to explain. So what is a tax credit? So for certain types of assets, let's say you've got an Australian rental property and you rent that out in Australia and you bring in the money into Thailand, the rental income, then you can potentially use the tax paid in Australia as a tax credit against the Thai tax owed. So you have to file a tax return, but for things like rental property income, you can deduct off the tax paid in Australia as a tax credit on the tax return. So that's how we use the double taxation agreement, depending on what it says. So let's go through some specifics. I mentioned earlier, for Australian pensions, civil service pensions, so you've worked for the Australian government or military, if they're remitted into Thailand, are not taxable in Thailand, only for civil service and military. If you have a super and you bring into Thailand and it's not a civil service pension, then it is taxable in Thailand for Thai tax residents if you are in Thailand 180 days or more. Investment capital gains, if you sell investments in Australia or elsewhere and you bring the money into Thailand, you are liable for the tax on the capital gains. For Australia, you can use the tax paid as a credit. You still have to file, but you can use the tax paid as a credit. And as I mentioned, for rental property income in Australia, you can use the tax paid as a credit on the tax return. And for dividends, yeah, they're taxable. If you bring in, you can deduct any tax that you've paid on those, like franked dividends, for example. So once if you know you have a tax filing obligation, let's say you do bring in pensions, for example, into Thailand, and it's not a government pension, it's not a civil service pension, then what allowances and deductions do you get? So everyone gets a personal allowance, 60,000. And if you're married and the spouse has no income, you get 60,000 allowance. You get allowances for kids as well. So 30,000 per child, 60,000 if they are born after 2018. If you are over 65 or older, you get another 190,000 allowance. And if you have things like Thai health insurance, you get 25,000 deduction as well. So there are other things like charity donations, but these are the key core ones. Once you've got your income that you're bringing into Thailand and you've deducted off your allowances, then we start to look at the tax tables. So it's a bit small in there, but okay. All it shows is that it's progressive, same as Australia. So the first 150,000 baht after you've taken off your allowances and deductions is tax exempt. And the next 150,000 is 5%. And that goes all the way up into the 35% bracket over 5 million Thai baht of your allowances and deductions. So I think the easiest way to explain this is through case studies, and then we'll go through a lot of the Q&As at the end. So what I've done is just tried to separate this out. I've focused on pensions, obviously, but then I've also added one in for investment capital gains because we've had a lot of questions about that. So I thought I'd add it in. So I've looked at low income with a high deduction. So people that are bringing in a low pension income, someone who's bringing in a high pension income with no deductions. I've looked at people who encash their superannuations as a non-Thai tax resident, so unrestricted access. I looked at that as an example. And then obviously capital gains as well. So let's go through the examples. I think this will help clear up a lot of the questions. So first case study. So someone who's bringing in 600,000 Thai baht per year from their super. They're 65 years old. I think this really will help people understand, like, there's nothing to worry about for most people. And the tax in Thailand is quite fair in terms of the allowances and deductions. So it's for a lot of people, it's more of an admin issue than a punitive tax issue. But you know, they potentially do have to file. So this example, someone who brings in 600,000 Thai baht from their super, 65 years old, and they stay in Thailand 181 days in a year. So they're a Thai tax resident. They're married with a spouse without an income, and they've got local insurance. Well, that will help with the deductions. So let's add up the deductions for this person. So if they're 65 years old, they get 190,000 age allowance, 60,000 personal, 60,000 spouse. They get 100,000 because they're bringing in pension income, and also they get the medical insurance allowance because it's a local insurance. So for this example, for this person, they've actually got 435,000 Thai baht of allowances and deductions. So we know that they're over the threshold. So the threshold to file is 220,000 Thai baht because they're married and they're bringing in a pension. And we know that they need to file a tax return. So our essential tax filing, 7,500 baht, is the most suitable for them, most cost effective. So let's have a look at the tax table. How does this actually look? So it's a bit small, but I'll talk through this. So we add on the 600,000 Thai baht. We deduct off their allowances, that's 435,000. And then that means that their taxable income on there is, just have a look on that. It's really small on my screen. It means that once we deducted that off, then we look at the tax table. So it shows there's only a small percentage that is over the tax exempt threshold. So if someone's bringing in 600,000 Thai baht and they've got these allowances and deductions from their super, it means their tax bill would be negligible, 700 baht per year. So it just shows you that it's not worst case scenario for most people. It just depends on what allowances, deductions they've got as well. So in that case, there's not really much tax to pay. They'd have to file and they'd have a minimum amount to pay. So let's look at another case study. This one is a person with a higher income. So they're bringing in 2 million Thai baht per year. And they are 62 years old. So they don't get as many allowances and they are single. They stay in Thailand 181 days, so they are Thai tax resident, and they bring in 2 million baht from their super. So let's have a look how that affects their situation. So all they get is the personal allowance, which is 60,000, and also 100,000 because they're bringing in a pension. So we know that they're over the threshold. So for a single person, it's 120,000 Thai baht if you're bringing in pension. So what does it look like on the tax table? So I'll talk through this. So we add 2 million Thai baht. All we can deduct off is 160,000 Thai baht as the allowances and deductions. Then you can see there's a lot more in the tax table here because they've got a higher income. So for this scenario, they'd have to file a tax return. Their tax would be 325,000 Thai baht, so 16%. So you can see if you don't have the allowances and deductions, and you're bringing in a larger amount from super, it can make a big difference on there. So if you would like to go through tax calculator, feel free to get in touch. We can help with this. This is an example if the person did have the same allowances as the first person, so the 65 plus, they've got insurance, they're married. Well, that would reduce their taxes down by around about 80,000 baht per year. So it does make a big difference there. Okay, if you would like to go through this, feel free to get in touch. We do have a service where we can do that for free to go through the tax calculations with you. So let's have a look at a third example. So a lump sum in cash. So they are 65 and they take unrestricted access. They take a lump sum out of their super. And they do this in a non-Thai tax year. So they stay in Thailand less than 180 days in the year that they disinvest their super. Now, if they do that, so they have unrestricted access because of the preservation age, then it means that they would have no tax implication in Australia and they would have no tax implication in Thailand because this event happened in a non-Thai tax year. So they wouldn't have to file a tax return in Thailand because they disinvested that when they were a non-Thai tax resident. There'd be no need to file a tax return for that amount and it can be brought in any time in the future. So let's go through the investment case study. I know we talked about pensions, but a lot of people have asked this, so I thought I'd add it in. So an example, 60-year-old, they've got an investment account in Australia, so general investment account, stock portfolio. They stay in Thailand 190 days, so they're over the tax threshold, tax residency threshold. They sell 50,000 Aussie dollars of Bramble shares, and the all-time gain is 40% on those shares. So let's calculate if they bring that into Thailand in the same year that they disinvest and they're a Thai tax resident, what's the tax implication? So they send the full amount, so 50 grand's about 1 million Thai baht, and they've got a 40% capital gain. How much is the tax? So first of all, we do the tax calculation to work out the original capital and the capital gain on the money that's brought across. So with this calculation, you can see that the capital gain on 50,000 Aussie dollar with a 40% capital gain, if you bring that into Thailand, the capital gain we put down on the tax return is 314,000 Thai baht. That would be income in that year. So you can see on here, it's quite small, but I'll talk through it. If someone were to bring in 50,000 Aussie dollars and they've got a 40% capital gain and they've got this person's allowances and deductions, then they'd have a tax bill of 5,200 baht. That's all. So you can see, to be honest, for a lot of situations, it's more of an administration issue rather than a punitive tax issue. So it depends case by case on what they're doing. So it's important to seek advice or at least go through the tax calculator. We'll send out the link after this where you can book in a meeting with one of my colleagues, Jason or John, to go through this in more detail. We can also offer one-on-one consultations to go through your own situation and do a bit of planning in terms of and explain exactly how this looks for your own situation. Feel free to get in touch. It's very popular. And it's been, Thailand's actually had a lot of the banks the K Bank have actually sent out CRS requirements, so common reporting standard requests for information. It's becoming a bit more plugged in now, Thailand. So it plugs in directly with the ATO, for example, with common reporting standards. Nothing to panic about, but you need to provide the information to K-Bank in order to maintain your account, for example. So that's the way this will be moved forward, is actually the banks will have to collect the information on behalf of the Revenue Department. So what are the implications of not declaring? Okay, like all tax authorities, especially ATO, is they're quite punitively tax if people don't file correctly or on time. So the penalties for filing late are 1.5% per month for every month it's missed. If people don't file and they are audited, then they can be fined 200% of the tax that's owed. And obviously, if they don't pay that, then like all tax authorities, they've got the right for more serious punishments like imprisonment and fines and visa cancellations, for example. So with our services, we can help with free tax calculator to actually assess exactly what your situation's like, whether you have tax to pay or not, and how to file. Obviously, we can help with one-on-one consultations and file taxes. We can help obtain tax ID numbers, and we are here to help. Just send in your questions. We're happy to get back to you and with our live webinar answers. So things are going to change even more in Thailand, in my opinion. They're going to move to worldwide taxation in the future, whether that's in the next year or 2 years or 3 years, it will happen. So it's important to keep up to date. Like, for example, the CRS information, I sent out the information within 2 days, how people complete the forms and what to do. If you sign up to our tax alerts, we'll keep you on the list for any changes towards the tax in Thailand and keep you updated. So what are the tips and strategies for Australians and people who've got Australian assets? It's really important to calculate the potential income tax for the different asset classes. So they all vary. So for example, rental property income, you can offset any tax paid in Australia, but file. For pensions, if you bring in super, you have to file in Thailand and pay the tax in Thailand. If you disinvest investments, then you are liable for the tax on the gains, less any tax paid in Australia. For example, it's important to see what tax credits you've got available and deductions, because that, like we showed on the case study, it makes a big difference. You might want to consider the LTR visa if you meet the criteria, because that is exempt from foreign sourced income. It's important to keep a good record, even if you don't need to file, just in case you're asked, and track all the transfers to Thailand. Separate out the different income sources, if possible, what you're bringing in, so it's easy for the calculations. And also, you could use the cash in the bank that you've got from previous years rather than bringing in all income. So making sure you're smart on what you actually do remit in, or with investments, bringing in things with lower gains or investment losses. If you would like any specific advice, feel free to reach out. So let's get on to the questions. We've got quite a few in by email, and I'll try and answer these as we go in through. So first one, my wife and I started living in Thailand in 2020 during our working life with compulsory super. I'm in an accumulation account in a pension account. Currently, the monthly compulsory drawdown is 5%, is $8,000 a month. We live off some of the income here in Thailand. I'm interested to know what my tax liability will likely be on 5,000 Aussie dollars I transfer every month into Bangkok Bank. Can we split it to minimize our tax burden? My wife has a Thai bank account also. So let's answer that first. If the income's from yourself, you can't just send the money to your wife and split the income. It's still your income that you're remitting to Thailand. So it's on your personal tax return. So let's have a look how the tax return would look for this specific person. So if they bring in the amount now, what did I say? $5,000, then 60,000 a year, 1.3 million Thai baht. They can take off their allowances and deductions, which for this example is 410,000. So their taxable income would be 926,000 for this example. So for bringing in this amount with their situation, the tax would be 100,000 Thai baht, 100,354, 7.5%. So they could file with our essential tax filing service for 7,500 baht and remain compliant. Do we get any write-off stroke deductions, medical expenses, etc.? So with Thailand, you can, if you have Thai local medical insurance, you can deduct off up to 25%, 25,000 Thai baht of the premium. So if it's more than that, you don't get any more. You can't claim for your spouse on there. They can only claim separately. So that you can't claim for medical expenses, just for if you have local medical insurance. What do you say to all the Aussie expats living here to tell me that they're just going to ignore this and that Thailand don't have the manpower or technology to catch them? I think the key is, that's a very good question. I think the key really is this, the common reporting standards tax alert that we sent out, that the banks are starting to collect the data on behalf of the Thai revenue and the ATO directly. So they've written out to all people from Bank, if people don't complete the forms before the 20th December, then people can have implications in terms of closing bank accounts. So that's how they're going to enforce this. It will be through the banks and the financial institutions that will inform ATO or the Thai revenue, who will then share the information. And they are taking it serious. We had an interview with the revenue last week, and yes, they understand exactly bringing in pensions and that this is on their radar to look at in terms of tax returns. Long question here, but I thought I'd add it in because it's quite relevant. There's quite a lot of interesting parts here. So first one, retired on an O visa and have a pink card. I believe that a pink card could be used as a tax file number. Yeah, it can, but you need to register that yourself. So you can register the pink card to be able to use for your tax ID, or we can obtain a tax ID for you separately. Next question. I receive an Australian old age pension. So age pension over income every 4 weeks. Don't submit a tax return in Australia. The age pension is not excluded under the double taxation agreement. So it's likely you have to file a tax return, but because of the amount that you'll be receiving, it will be reasonably low. So it's likely you have to file, but don't have a tax implication due to your allowances and deductions. But you have to file. So yes, so you have to file that on a Thai tax return from the 1st of January all the way until the 8th of April. The tax year is not really relevant for this. Follow the Thai tax year. So hope that those questions have been useful. What I'll do now is, let me just close this down, then I can actually, 1 second, let me do a bit of maneuvering around. Let me close this down, then I can put the questions on the screen. Just give me 1 second. Right, okay, we're ready. Okay, let's go through the questions now. Right, okay. Let me have I'll put them on the screen rather than me reading out, if that's all right. So if my friend sends money from China to Thailand bank, but lives in China most of the year, are there tax related issues? Yeah, sounds quite complicated situation. So I assume this means the person sending the money is a non-Thai tax resident and they're sending the money to their Thai bank. If they're a non-Thai tax resident and the money isn't earned in Thailand, it's not domestic income, then it shouldn't have tax related issues in Thailand. They can remit that to their own bank account. Let's go through the questions. Is the Australian pension subject to taxation. In tax in Thailand, there seems to be conflicting information on this. Yeah, it's quite clear in the double taxation agreement that it's not excluded. If it's remitted into Thailand, it's the same as other countries where you have to declare on a Thai tax return. Gone through that already. What if I transfer all parts? All right, yeah, okay. I have a question here about gifting. So what if I transfer all or part of my Australian pension to my Thai wife's bank account instead of my personal account as a gift to her? Okay, so the gift tax rules are really for reducing down inheritance tax. So the Thai inheritance tax rate is over 100 million Thai baht per person. That's really what the gift tax rules are for. It's not to reduce down income tax. So you can gift money to your wife, but if the money you are bringing in to gift to your wife is assessable income for yourself, then it's assessable income. Then we won't get around the income tax. You still have to file personal income tax for the money that you gift to your wife. It would just mean you wouldn't fall under the gift tax rules also if it's under 20 million Thai baht. So that's not really an option for tax planning. Unless you're a non-Thai tax resident, then you can gift to your wife in Thailand. Look at some more questions. All right, this is a good question about. It's a long one. Let me separate it out so it's easier to read. Let's do it in two parts. So I've been living in Thailand 20 years and the Australian government has classified me as a non-resident for tax purposes. Fine. Okay, which basically means I pay 32 cents on the dollar for all my income from my rental properties. Okay, that's clear. Next part. Plus, when I sell my investment property in Australia, we'll receive no CGT discount and other Australians would receive normally. $32 on the dollar. So does this mean I already paid $32 on the dollar? Does this negate paying tax in Thailand if under 5 million Thai baht income level? So yeah, if you bring in your Australian rental property income and you're a Thai tax resident, then you have to file it on a Thai tax return, but it's more than likely that you will have more of a tax credit than the tax owed in Thailand. So you need to file with the tax credit, which is a bit more complicated. Yeah, our assisted tax filing is suitable for that. But yes, in effect, it's not like, because you pay more tax in Australia, then you don't have to pay more tax in Thailand with the double taxation agreement. That's quite fair. Thailand Revenue Department have in good favor that you can use that as a tax credit. Also on the property sale, same principle applies. If you sell a property in Australia, you can use the tax paid on the capital gain as a credit if you do bring into Thailand, but you will be liable to file for the property sale if you bring the money into Thailand for the capital gain. But you can use the tax paid as a credit. So I hope that's useful. Good question. Right, okay, another question. What about younger under 50 sole traders bringing a salary and income earned in previous financial year? I assume this means people that are living in Thailand and earning income or salary overseas and then bring in that income or salary into Thailand. Now, the rules changed this year that you can't, if you bring in income from a previous year, that the rules changed on the 1st of January 2024. Whatever income you bring moving forwards, if it was income earned from 2024 and you bring it into Thailand, it's assessable income. So you bring in income, you have to declare that on a Thai tax return moving forwards. If you've got cash in the bank as of 31st of December 2023, that can be brought in. But if you've got new income, yeah, that has to be declared on a Thai tax return, whatever's remitted. Right, let's look at this question. Good one. Do you still claim tax credit transactions in Thailand are accessible? Do you still claim credit card transactions in Thailand are accessible? So I assume this means if you use a credit card in Thailand and you use that to pay for expenses and costs, then we need to look at, is it within the spirit of the tax rules what you're using to pay off the credit card? So if you're using it to circumvent bringing in foreign source income, so let's say you're using taxable money that's left overseas to pay off the credit card and you're using the credit card to pay off to pay for things in Thailand, then that's tax avoidance, tax evasion actually. So make sure that you pay that off with non-taxable money, then you can use the credit card. But if you do use potentially taxable money to pay off the credit card, then that's assessable income and it doesn't follow the spirit of the tax rules. All right, I've got one question. I should have cleared this up. So I've had quite a lot of questions from about, oh, that's a mess when I pasted that in. Sorry. It looks okay on the screen. You said that the cash balance pre-23 is not taxable. Let's say my balance of my self-managed super at the end of 24 is 1 million. Does that count as cash balance? No. So unfortunately, this is just cash in the bank, not cash balances in pensions or balances of pensions or investment balances. It's cash in the bank only. So there's an announcement in November last year. It doesn't correlate to pension. So with this managed super, it was $1 million. All we care about is what do you bring out and bring into Thailand. We don't care on the value, actually. It's not on the capital gains for supers. It's on the income. So if you bring the money out, so take an income, bring it into Thailand, whatever you bring in is classed as income. Hope that clears that up. Okay, good question here. Let's have a look. I've not really read it through, but it looks complicated, so I thought it'd be good to put on. You said that income from the super is taxable. If I withdraw a lump sum from my super and bring it to Thailand, is this taxable as it is not super pension, just a withdrawal of my savings held in super pre-24? So it all depends on when you disinvested that super. So if you disinvest the super in a Thai tax year, then yes, if you bring it in, then that's assessable income as income. If you sold the super in a non-Thai tax year or before the rules change pre-24, then that's different. So this might be one to have a detailed conversation just to make sure that you, yeah, whatever you do, you make sure it's right. Someone's wrote your website says it's not taxable. I don't really know what that means. So if all yeah, civil service pensions are not taxable. Yeah, so someone mentioned about, oh, okay, I understand now. So someone's mentioned about Australian government pensions and not assessable income yet. So that on our website, what we actually mean is civil service pensions. So yeah, as if you worked for the government, not just super pension, but actually a government employee, civil service, military pension. Got a few more questions. I'll try and do as many as I can. Okay, we did explain about gift tax rules. So we need to go through that. Government pension. Yeah, we've answered the government pension question as well. Right, okay. So look at this one about inheritance. I'm due to receive an inheritance from sale of my mum's house, subsequently to her passing away, about 300,000. If I bring all or part of this to Thailand, is it taxable? What evidence will I need to show? So if you receive an inheritance in overseas, you can bring that into Thailand. It's not assessable income in Thailand. So you just need to keep the documentation. So the will, probate, the doctor's letters from the lawyer, just to show that that money's from the estate. That's all you'd need as evidence. You don't need to file that on a tax return. Okay, good question here. So I receive a pension fund from a police state super. Is it up to me to prove it's civil service pension or wait till they ask or hope they accept it? So yeah, good question. So if you have an income source that's excluded from the because of the double taxation agreement, then you don't need to file that on a Thai tax return. So you just need to keep a good personal record. So if you are ever asked, then you can provide the evidence that it's from the police super and not anywhere else. So yeah, just keep a good record yourself. You don't need to file, you don't need to submit that anywhere. Okay, so good question. I get this question quite a lot. So when remitting 800,000 Thai baht, I assume that's for the retire. It doesn't mention it for the retirement visa purposes. Also, I need to pay tax on that amount. It depends. I mean, if you bring in cash in the bank from previous years, then no. If you bring it in foreign source income, then yes. Okay, one complicated one that's really worthwhile having a more detailed conversation. If I receive an inheritance in the form of shares from my mother who passed away last year, where do I stand with the money I brought in to buy a condo here? So, yeah, if you receive the shares, were disinvested and then moved across, if it's an inheritance, then it's not assessable income. If you received the shares and you didn't sell them for a long time period, then it could be looked at that they are your shares. So yeah, reach out if you'd like to discuss that in more detail. Any more questions? Okay, so I think that's everything on there. So I hope that's been useful. I'm happy to take further questions if you've got any more. Um, if you would like any help, we've got quite a lot of questions that are answered on our frequently asked questions site on our website. A lot of useful videos and help as well. If people would like help with tax ID numbers or tax filing, feel free to get in touch. We've got an online client portal. And if you do have any questions, feel free to reach out. We're happy to help. Thanks. Bye bye. Have a good evening.